Hey everyone, and welcome back to the Finance Zone. Looking for an investment that offers regular income? High-dividend stocks can be a good choice. Income investors generally want to maximize their dividend yield, but unfortunately, a winning investment strategy is not as simple as running a screener and buying shares of the stocks with the highest yields at a given moment. A dividend yield might reach high levels because the market is pricing the stock with the assumption that the dividend per share will decline in the future. Dividend stocks distribute a portion of the company's earnings to investors on a regular basis. Most American dividend stocks pay investors a set amount each quarter, and the top ones increase their payouts over time, so investors can build an annuity-like cash stream. You need diversification if you're buying individual stocks, so you'll need to determine what percent of your portfolio goes into each stock. For example, you're buying 20 stocks. You could put 5% of your portfolio in each. Today, we're going to be talking about the best high-dividend stocks to buy now. Be sure to stay till number 1 to learn the best advice to keep your money. Number 10. Target Corp. First on the list is Target. Perhaps its dividend yield of 1.6% leaves something to be desired for most income investors, but rest assured, as it's the only one of the 10 picks yielding less than 2%. Target is coming off an impressive 2020, during which its stock continued reaping the rewards of its renewed focus on digital sales, rising about 35% year-to-date through mid-December. In 2017, Target announced a $7 billion multi-year investment plan to make itself more digitally minded, and those investments are paying off big time. Last quarter, digital comparable sales rose 155%. The percentage of TGT earnings used to pay its dividend, known as its payout ratio, is low, at just 35%, indicating the dividend is safe and has room to grow. Number 9. Enterprise Products Partners. Enterprise Products Partners is the largest publicly traded master limited partnership, or MLP. The company provides midstream energy services, including gathering, processing, and storing natural gas. Bank of America analysts say Enterprise's approximately 35% drop in 2020 is a reflection of investors' lack of appreciation for high-quality yield within the midstream energy space. In light of the stock's underperformance, management said it is shifting its priority from increasing its payout to ramping up share buybacks in 2021. Enterprise Products pays an 8.9% yield. Bank of America has a buy rating and a $24 price target for EPD stock. Number 8. Microsoft. As one of the largest companies in the world, Microsoft has steadily increased its sales. And an especially attractive feature for dividend investors is its focus on recurring or subscription-based revenue sources. The company has a solid balance sheet and with more cash than debt and a very low payout ratio that leaves tons of room to grow the dividend. Given its 18-year streak of dividend increases, we wouldn't be surprised if Microsoft joins the Dividend Aristocrats Club soon. Number 7. Apple. Tech giant Apple has been paying dividends for only a few years now, which is understandable given the rapid growth it experienced in the early years of the iPhone and iPad. Companies tend to choose to reinvest profits into the business while in growth mode. Even so, Apple has an incredibly loyal customer base, and since its devices are designed to work well with each other, the company has a nice tech ecosystem that should help keep its revenue strong. And Apple's rapidly growing subscription services businesses are providing a growing source of recurring revenue. Number 6. Griff. As the smallest company on this list, with a $2.3 billion market capitalization, industrial packaging and container company, Griff can provide some mid-cap diversity to a dividend portfolio. This is a slow grower, but with a dividend of 3.7% and a price-earnings ratio less than 18, the stock is priced decently, especially with analysts expecting earnings per share, EPS, to grow 10% annually over the next 5 years. If and when the global economy picks back up, this maker of steel and plastic drums, corrugated sheets, container liners, and other behind-the-scenes packaging products will see an uptick in demand. Griff's products are used by all sorts of industries, with customers in the pharmaceutical, petroleum, food and beverage, and chemical sectors, to name a few. Number 5. JPMorgan Chase Co. For banks, 2020 was a down year. Interest rates plunged, narrowing the all-important spread between what a bank pays for borrowed money and what it charges for loans. Even JPMorgan Chase Co, the most valuable bank in the U.S., with a valuation of around $365 billion, wasn't immune from those headwinds, falling about 13% year-to-date through mid-December. This offers a good buying opportunity for patient investors seeking a safer asset with a decent yield. As one of the 30 members of the vaunted Dow Jones Industrial Average, JPM pays a 3% dividend and enjoys an attractive payout ratio of 47%. Last quarter, JPMorgan reported a 30% increase in trading revenue, along with record revenue and net incomes in its wealth management division. Number 4. Johnson & Johnson. Johnson & Johnson is an American multinational corporation founded in 1886 that develops medical devices, pharmaceutical, and consumer packaged goods. Jones component Johnson & Johnson, J&J, is among the pharmaceutical companies leading the charge towards a coronavirus vaccine. Now J&J stock is edging closer to a buy point out of flat base. Johnson & Johnson is the number one diversified medical stock by market cap. Among its wares are immunology, oncology, and neuroscience drugs. In the third quarter, these three segments generated nearly 3/4 of J&J's total drug sales. Operationally, on a strict as-reported basis, all three units grew. All told, Johnson & Johnson's drug sales increased 5% on an as-reported basis to $11.42 billion. Operationally, pharmaceutical sales rose 4.6%. Amid the coronavirus pandemic, medical device sales have suffered for many companies. J&J wasn't immune in the third quarter as devices revenue slipped 3.6% on an as-reported basis to $6.15 billion. Johnson & Johnson is among the bevy of companies developing treatments and vaccines to tackle COVID-19. On September 23rd, the company said it started Phase 3 testing of its vaccine candidate. It aims to enroll as many as 60,000 participants in clinical trials to determine the safety and effectiveness of its vaccine. It said it expects to seek emergency use authorization for its vaccine in the first quarter of 2021. Number 3. Kinder Morgan. Pipeline giant Kinder Morgan is one of the largest midstream oil and gas companies in North America. With oil and natural gas prices struggling thanks to overproduction and lower demand, now is a good time to check in and see how these industry leaders is doing. Apparently, Kinder Morgan CEO Rich Kinder has been listening to Wall Street's plea for energy companies to monitor their debt loads and keep their balance sheets healthy. Kinder himself made it a point to emphasize his company's focus on scaling back expansion projects and growth potential so that Kinder Morgan will have strong cash flow to pay its dividend and maybe even buy back shares down the road. Last quarter, Kinder Morgan was able to raise its dividend by 5% to $1.05 annually, or $0.2625 per quarter. It had plans to raise its annual dividend to $1.25 per share in 2020, but the company says that's very unlikely now. Kinder Morgan has shown it's taking its debt and dividend more seriously than in the past. The main takeaway from Kinder Morgan's second quarter earnings call was that it is truly embracing a transition to a slower-growing, leaner company that focuses almost entirely on its dividend and balance sheet. That's good news for income investors looking for a high-yielding dividend stock with a somewhat low amount of risk. The stock currently yields over 7%. Kinder Morgan's guidance suggests that the company is much more resilient to low commodity prices and a weak economy than other energy stocks. Its portfolio looks strong considering it thinks it can fund its business and dividend payments entirely with cash. Kinder Morgan looks like a good buy at this price. It's refreshing to see management tone down the expansion rhetoric and focus on financial health. Number 2. Verizon. While VZ stock has consistently underperformed the S&P 500, Verizon stock often attracts income-oriented investors. If 5G wireless service reignite earnings and revenue growth, however, VZ stock might have a much greater appeal. Verizon's challenge is regaining an edge in network performance as 5G wireless applications emerge. JPMorgan recently upgraded VZ stock on new revenue sources developing in 2021, with more impact in 2022. Thanks to low interest rates, Verizon stock has posted some good runs since the global recession of 2008 and 9. The telecom giant at one point jumped into the IBD leadership board. It's a curated list of leading stocks that stand out in technical and fundamental metrics. Verizon is much more exposed to the U.S. wireless market than rival telecom AT&T. Verizon gets nearly 85% of adjusted earnings from its wireless business. Number 1. China Mobile. China Mobile is the world's largest telecom company. Like AT&T, China Mobile isn't getting much love from investors in 2020. Given the stock is down about 30% year-to-date, Morningstar analyst Dan Baker sees brighter days ahead in 2021 for China Mobile. Baker says China Mobile's scale helps the company achieve higher margins and higher returns on invested capital than its competitors achieve. Baker says the stock is attractively valued, trading at around 6.8 times projected 2021 earnings. China Mobile also pays a dividend yield of about 7%. Morningstar has a buy rating and a $52 fair value estimate for CHL stock. Final say. The number one consideration in buying a dividend stock is the safety of its dividend. Dividend yields over 4% should be carefully scrutinized. Those over 10% tread firmly into risky territory. Among other things, a too high dividend yield can indicate the payout is unsustainable, or that investors are selling the stock, driving down its share price and increasing the dividend yield as a result. Then look at the stock's payout ratio, which tells you how much of the company's income is going towards dividends. A payout ratio that is too high, generally of 80%, though it can vary by industry, means the company is putting a large percentage of its income into paying dividends. In some cases, dividend payout ratios can top 100%, meaning that the company may be going into debt to pay out dividends. Thanks for watching. While you're here, go ahead and click on one of these 2 videos on your screen, and don't forget to subscribe, like, and comment below. See you there, and thanks for watching.